All right. Good afternoon, everyone. Welcome to Next Gen Professional Associates. I am Ibrahim Akindele. I will be taking you 70% of the syllabus. As you all know that there is kind of a change. There is a change in the syllabus. I'll be taking you 70% of the syllabus. Why my boss, our Oga, Mr. Ibrahim Ajibola, MNIFCA, will be taking 30% of the syllabus. Distinguished professional colleagues, SFM, let me quickly establish something here before we start proper introduction. Please make sure if you are not ready for the class, just mute your mic. Mute your mic. And please, you can make use of the chat button, or you just signify by raising your hand, right? So if you have question, please, so that we will not have some kind of destruction while we are starting our class, right? So please, let's all abide by this rule so that we can be able to achieve the objective. Distinguished professional colleagues, I am Ibrahim Akindele, and I will be taking you 70% of the syllabus. Now, apologies for starting late. You know, it's supposed to be 12 p.m., right? 12 noon, and this is 12:04, right? I need to apologize because my classes usually start at that 12. When I say class will start by 12 p.m., we move by 12. If it is 8:30, it's 8:30. So apologies for starting at this time. Now, I think we need to actually introduce ourselves. Okay, just a brief introduction. Probably when I'm taking question, we'll start the introduction, right? So please, SFM is very simple. It's very easy to pass, and it is very simple to pass and very easy to fail, right? So what we normally do is for us to do what we strategize, as well as our explanation will be practical, so that the worst case scenario, you forget one or two things. But because IB has actually mentioned that this thing actually happened then on investment, so you can use that knowledge to do what? To put down something, right? So please, most of our work, when we get to a topic whereby it is not practical, it is not because it is not practicable, but because I'm not there. So I don't really have full explanation, but I can still tell you that, okay, those guys that are in this part, this is what they are doing, and that is what we do, right? And you could see the pass rate last diet, because what? We incorporate practical. It is not theory, right? ICANN exam has gone beyond lecturing or tutoring with theory according to textbook. No, it is based on your understanding, right? Now, quickly, I need to introduce the I don't know if our guy is on this call. I doubt. Okay, he's not actually on this call. Okay, that's fine. Okay, let me quickly introduce the changes in syllabus before we move to today's topic. Please confirm if you can see my screen. Please confirm.
Yes, I can.
Okay. That's good. All right. So before now, SFM content, it is not usually like this. However, because there is a change in syllabus, so many things you see CSME was actually included in the syllabus. Class, ICANN did not want to test you whether you understand corporate governance or risk management or strategic management. ICANN want to test application of that knowledge. And that is why you will see our Mr. Ibrahim Ajibola, we bring a case scenario, right? We bring a case scenario. I can want to test. How can we test your knowledge on application? Not, we know you know corporate governance. We know you know risk management. We know you know our strategic management using the models, right? So we have here introduction to business strategy and financial management. This takes about 10% of the syllabus. 10%, which is very, very what? Very, very important. Our guy will actually take this part, which is 10%, covering 10% of the syllabus. Why? We have strategic management covering 10% of the syllabus, strategic analysis as well. We will be taking the 10% as well, right? Then the risk management, 5%. We also take this part of risk management of 5%. Now, governance as well, 5%. I think it's about 30% of the syllabus. Why? Our focus, you and I, our focus will be from E to F, which is the 30% of the syllabus usually be the compulsory question. But then let's see how it goes, right? Don't let me give you some level of assumption, but it is what it is. 30% of the syllabus, right? You can see what it entails, right? You can see what I've sent it to this to the platform before now. You can all see what it entails. We get there, right? 25% acquisition. One of my best topic in strategic financial management is merger and acquisition. And usually, before now, merger and acquisition usually compulsory, you know, but because of the changes in the syllabus, you could see acquisition, mergers, reconstruction, and reorganize. When we get to this topic, you will appreciate that you are in next gen professional associate SFM class, because we'll bring in practical, because it is no more theory, it is what is happening day to day, so that you will remember, right? Now, covering 25% of the syllabus, which is very, very important. Wow. Advanced risk management techniques, right? The foreign currency and all that, money markets, hedging, we'll get there. Taking about 15% of the syllabus. Distinguished professional colleagues, all these are very, very important. But both of us, we have work to do. Please, I need you guys, I need you all, sorry for using guys, I need you all professional colleagues, distinguished professional colleagues, for us to work together so that we can achieve a specific objective. And what is our objective? Is for everybody to pass strategic financial management. Our focus, you and I, our focus, right, will be, we start from the 30%, right? And starting with the 30%, we cannot just go and start with investment appraiser. No, it is not. There's a step, and that is why you are here. There is a step we need to follow. Now, we will not start from there. We'll start with cost of capital. Class, it is assumed that if you understand cost of capital, you've understand at least 60% of the syllabus. Do you know why? 60%. Do you know why? It is because there is no topic today in SFM that will be treated without the mention of cost of capital. So the earlier you understand the concept, the better it is. And don't worry about that. We'll break it down. We'll break it down to the extent that even when you, for my people that are in Lagos, even when you are in traffic, you will remember that IB said, okay, it's like this. We'll break it down, right? So please, cost of capital is very, very important. Please understand it. If you have questions, don't worry. I know you have questions for me. Don't worry about that. Right? I'm also prepared for your questions. Right? And don't forget, nobody is perfect. So if you ask question, I'll look at it, okay? Okay, let's meet in the next class. That's fine. But guess what? Guess what? All your questions will be answered. Yes, I will provide solution to it, right? Now, let's start with the introduction. Class, are we still together? Do we have anyone who is against me in this class? If you are against me, let me know. Class.
We are with you.
Okay, that's fine. I need to confirm.
We are very much with you, sir.
All right, all right.
We are
All
with
right.
you, sir.
That's fine. That's fine. Okay, I will share my screen. Please, if you are yet to subscribe to our YouTube, please kindly subscribe so that you will get all the information that has to do with the recording of the classes and all that. You get it on the YouTube. Please, if you are yet to do that, please kindly go and subscribe to our YouTube channel. Thank you. And don't forget that this class is a free class. And please, I don't want you all to take it for granted, because Next-Gen Professional Associate, I said it last diet. I mentioned it last diet that Next-Gen Professional Associate lectures are free today. It may not be free tomorrow. So why can't you take advantage of this opportunity to move your professional career forward, right? Beyond what? Beyond ICANN. So please focus. At the end of this class, at the end of the SFM class, right? At the end of the SFM class, you should be able to see yourself as an investment analyst, financial analyst, right? Or a portfolio manager. Oh, unfortunately, they've moved portfolio. One of my best topics as well, portfolio theory. They've moved it to FM, right? You should be able to see yourself as those guys, those fixed income guys as well in finance. So there's a lot to discuss. Please, let your mind be here, right? Ask question. Ask question if you don't understand. When we move, when I ask, okay, do you understand? Say no. Just make use of your chat, the chat button, or you signify. Don't worry. I will answer your question, right? I will repeat it again, right? So please confirm. Can you see my screen? Cost of capital. Please confirm if you can see my screen clearly.
Clear.
Thank you.
Yeah, I can see that.
Thank you. Thank you. Now, let's quickly move. Now, before we talk about cost of capital, something leads us to cost of capital. Unfortunately, I can move those elements to FM. Or we say, fortunately or unfortunately, I can move those elements to FM. And you cannot just say, oh, this is cost of capital. We are starting with cost of capital in SFM. Something leads us to cost of capital. And what is it? It is the financial management. Now, let me quickly establish a background before we move. There is strategic financial management. I know Oga will still explain that part, but let me pick it from the financial management. Now, I want to explain what leads us to cost of capital. It is actually something. And what is it? Financial management. Class. The question is, what is financial management? Financial management is when an organization or let me say the financial affairs, in simple terms, financial affairs of an organization is properly managed to achieve a specific objective. The financial management involves planning and controlling the financial affairs of an organization to achieve a specific objective. Plus, there is no how you will achieve that specific objective without strategy. Okay, we explain more on that. It is not possible for you to say you want to plan and control the affairs of an organization to achieve a specific objective. You can't do that without a proper strategy. That is why we have strategic financial. Strategy will come before financial management class. Now, if you want to control the affairs, the financial affairs of an organization, who are those guys? Who are those guys? They are called right? They are called financial managers. The question now is, what is the function of the financial manager? Class, am I communicating? You can see where we started from. I want to explain why. Why we have after. Now, it's like I'm telling you a history of what happened before we get to this point, right? Which is financial management that involves planning and controlling our financial affairs to achieve it. It is not possible to control the financial without a proper strategy. That is why you have strategic financial management. Now, who are those guys that control these financial affairs? They are called financial managers. The question is, the financial manager make a decision, right? The question is, what is the function of the financial manager? What is their purpose? What is their purpose? What is the function? One, to make an investment decision, financing decision, dividend decision. The risk management is under the financing decision. Class, let me come again. Those guys who manage, the affairs, the financials, are called financial managers. And the question is, who are these guys? They make decisions. And what is their function? They make an investment decision, financing decision, then dividend decision. If you see the risk management is under the financing decision. Now, class, why do we have to start with the investment decision? It is because a financial manager will identify a project that is what? That is viable. Oh, okay, this project, if you invest in this project, oh, maybe it could be capital investment. It could be capital investment. Oh, there's no portfolio theory here. It could be capital investment. It could be shares. It could be bond. Could be commercial paper. Could be treasury bill. Right now, you look at it. Capital investment. Oh, this project is viable. Oh, let's go for it. We make money. We'll make a lot of. We'll maximize shareholders' wealth. We'll make money. Okay. Now you've identified this particular project. Now, when you identify this project, what's next? How do we finance it? That is why we have financing decision. Now, okay, this is the project. It is viable based on the business model, based on the financial modeling, right? Oh, yes, it is going to be viable. Then you look at it. How do we finance it? That is the next question, right? They will ask the financial managers, okay, this is it. How do we finance it? That is why we have the financing decision. Now, the project will not be financed either by equity or debt. That is what leads us to cost of capital, because we are talking about equity and debt. Now, you now look at it as a financial manager, you look at it, okay, do we borrow from the bank? Do we borrow from the bank? Or if it is a listed company, should we do a right issue to our existing shareholders? Right? What should we do? How do we raise fund? Right? How do we raise fund? That is the financing decision. Then the dividend decision. The project has been successful. In the financing decision, there is a risk management. Of course, you have to analyze the risk of either going by equity or going by debt. In some tests, they actually separate it. Then we have dividend decision. Now, the project is done. We have to pay our investors. So they make this decision, the financial managers, right? So one of the decisions they make is the financing decision. You know, we started from investing to financing, from financing decision to dividend decision. We pay our shareholders. So, okay, we are done with the project. Please, we have to pay our dividend. When we get to valuation of a business, we'll talk more on that. Or when we'll see in this topic, we'll talk more of dividend. Right? Now, I want to explain all this, and that is the financing decision part. That is what takes us to cost of capital. Class, am I communicating, please? This class is too dull. What happened? Am I communicating?
Yeah.
Yes, sir.
Yes,
We
sir.
are with you. Communicate.
Yeah.
Thank you. That's fine. Now we move. Now, I want to ask a simple question from the financing decision. If a project is viable, right? Oh, it has a positive NPV, it means you can go ahead and invest in that particular project. What are we trying to achieve? That is the question. What are we trying to achieve? Now, okay, I've talked about the function. The objective of a financial manager is to maximize shareholders' wealth. Class, that is not our discussion. It has been moved to FM, but I just need to give us, like, I need to bring something that you will know that yes, this is financial, this is SFM, not FM, this is SFM, not PM. Right? Now, the objective of a financial manager is to maximize shareholders' wealth. Right? What is maximization of shareholders' wealth? Is when a company is investing in a project that has positive NPV, increase in profitability, earnings per share, right? The share price is increasing, you generate more cash flow, the company is highly liquid, right? They minimize debt. These are the maximization. This is how both the financing and non-financial maximization of shareholders' wealth, right? Now, that is the objective. Objective is to do what? Is to create value for the shareholders. How can they? The question is, how do we now create a value? That is the question. How do we create a value for our shareholder? Is to ensure that we increase our profitability, the earnings per share, dividend, the cash flow, you minimize what? Debt, because the dividend is paid from the what? From the profit, right? So that is, by the way, actually. So I needed to establish that ground, that this is what actually what takes us to what? The cost of capital. The financing decision. Now, the financing decision, and that is what takes us to what? The cost of capital. Now, we move. You can see my screen. The overview. By the end of this topic, you should be able to. Now, let's quickly move to the definition of cost of capital. I'll be explaining two things here. Practical, right? The cost of capital is, you can call it a minimum return that investors are expecting from their investments, and requiring the company to pay back the principal and interest to the debt holder. Now, let me come again. You can see in that definition, there are two things there. I mentioned investors. I mentioned the repayment of debts, as and when due. The definition is of two ways. That is why it is called cost of capital. It is both equity and debt. Cost of capital is the minimum required return that investors are expecting. If you invest in shares, you are expecting dividend or capital appreciation. It is not mandatory for the company to pay you, even if they don't have money. They will tell you that, okay, we don't have money, you are a shareholder. Class, that is why it is the minimum required return that investors are expecting. You are only expecting it from your investment as an equity holder, as a person that you look at Fidelity, you look at Union Bank, look at Jitco, you buy the shares. You are expecting two things from your investment. You are expecting dividend or capital appreciation. Capital appreciation means that increase in the share price, market price. If you go to NGS today, you will see all this market price. So you are expecting either dividend or capital appreciation. That decision, you are the one that owns that decision. You can decide that as an equity holder, oh, let me go for dividend. Just go with pay me dividend, this dividend at the end of the financial year. Oh, let me take capital appreciation. Capital appreciation means increase in the share price, increase in the market price. I bought it at the rate of 20 naira per shares. Oh, Jitco then it was 65 naira per share. Now it is 86 naira per share. Oh, let me quickly sell. I'm not interested in dividend. You know, you are looking at capital appreciation or share price. Now that is for equity holder, shareholders, and requiring the company to pay back the interest and principal at the date of what? Maturity. As and when or at the date of what? Maturity. Which means that the company must pay back. We've talked about the equity holder. They are expecting it. Now, it is not requiring. The company must, because there is a covenant that you must pay your debt holder. Right? You must pay them back their principal and interest as at the date of as and when due. Right? So that is why it is called cost of capital. We have debt holder, bond, commercial paper, right? Treasury bill, excuse me, right? So you can see that is why it is called cost of capital, because it is the combination of both equity and debt. Mind you that the costs, it is the cost to the firm. it is a return to the order. Excuse me. Class. That is why you are talking about financing decision. How do we finance it? Let's source for money from bank. It is a cost to the firm. Bank will collect their return. It is the return to the bank. The company now do what? Okay, let's say we want to issue right issue now. Right issue is when you issue a shares below the market price. Right? Now, you issue a right issue, people buy the right, right? People, those existing shareholders buy the right. Fine. It is a cost to the firm because the firm will need to pay back the shareholders. It is not mandatory though, but they will expect returns on their investments. That is why it is a cost to the firm. It is a return to equity investors or debts or debt holder. We can call it a debt holders, right? Holders of debt capital. Class, in a nutshell, cost of capital is the minimum required return that investors are expecting. You are expecting it. It is only when we make profit we can pay you. And requiring the company to pay back the interest and principal to the what? To the debt holders or to the holders of capital. Which means that they must, because there is an obligation. Now, it is the cost, all these costs, it is the cost to the firm. Why you, as an investor, you are expecting, oh, it will be returns to you. Debt of that, the same thing. Of course, you will pay interest. The debt holder will receive interest, of course, right? So that is the definition of cost of capital. Class, are we still together? Who is against me in this class? I need to know.
We are together, sir.
We are together.
All right. I would explain this. As a financial manager, you now need to make your decision. Oh, you need to compare the equity and debt. The cost of that equity and what? And debt. You have to make that decision. Now, question could be maybe that give 5 reasons why cost of equity is usually higher than the cost of debt. Excuse me. Or make a comparison. Right? I've seen that over the diet on diet. I've seen such questions. That is why I'm giving an instance that you need to know this. Right? You don't even need to cram in. Just your understanding of equity and debt. You should be able to at least write maybe 3 to 4. You compare the cost of equity. Why cost of equity is usually higher than the cost of debt? Why? The comparison. Now, it may be 3 marks or 4 marks or 2 marks, right? It's part of mark, right? Thank you. Now, usually because the investors, shareholders, because they are expecting something for it is not starting class from their profits. That is why in the income statement, you will have profits before interest and tax. You will have profit before tax. They have settled interest, the debt holder. The balance is what? The net profit for the year. That is when the company can now pay you. If they make loss, you are on your own. That is why the cost of equity is usually, because the cost of equity holders take risk than the debt holder, because they are only expecting. It is not an obligation. 2, it requires that the company should pay back interest and principal to the debt holders, while the equity holder are expecting, they are just expecting return on their investment. 2. 3, during liquidation, when we get to reconstruction and reorganization, you will understand more of the debt structure, right? In line with Bankruptcy Act, we will see, because we need to look at the law in terms of distribution. When it comes to liquidation, we'll get there. During liquidation, when the company want to fold up, right, they have to pay the debt holder first before the equity holder. That is 3. I dash you the remaining 2, right? Go and look for the remaining 2. Are we still together? Class, are we still together? So
Summarize it again, please.
I should summarize it again. Okay. So when you look at it, the cost of equity usually higher, usually greater than, yes, because the equity is actually not secured. It's not secured. Debt is actually, so equity holder take risk. Debt holder did not take. I'm not taking any risk. Right? They are risk taker. Equity holder are risk taker. During liquidation, excuse me, you have to pay back. You have to pay back interest and principal to the debt holder before the equity holder. Now, equity holder are only expecting. We are just expecting what will come out. It is based on profit. It is based on what? Profit that will pay you. They are just expecting. Debt holder are not expecting anything. You must pay them because there is a contractual, there is an agreement, there is an obligation that you will pay them this particular amount as at the what? As at the date of what? As at the date of as at the date of what? As at the date of maturity. Class, are we still together? That is a summary of this. Okay, that's the summary. I'll share the material for those who have actually made their payments, right? I'll share it because I've received some mails and some other information. So the cost of equity. The question is, don't forget that cost of capital is divided into 2 from the definition. The cost of equity and debt. The cost of equity and debt from the definition. That is why it is called cost of capital. Now, we'll start from cost of equity. After when we are done with cost of equity, we will now move to the cost of debt. Don't forget, the cost of equity, it is the cost to the firm. You, as an equity holder, you are expecting something from your investment, which is a return, right? Either you choose dividend or capital appreciation. Capital appreciation means an increase in the share price, in the share price or goods, right? So you can make that decision. Now, the cost of capital, cost of equity. How do we calculate these costs? How? Which method are we using? How do we calculate this cost of equity? That is the next question. We've understood the definition, the reason why cost of equity usually higher than the cost of debt, the comparison. Now, the cost, the method of calculating these costs, right? The method of calculating the cost. There are two methods of calculating the cost, or I usually call it, I usually say, if you check the other method, what is it called? The previous material or some tests, you will see that, oh, some say there are 3 methods and some say there are 2 methods. Anyone, right? Whether 2 or 3, we are good, of calculating the cost of equity. Either you use the dividend valuation method or model, or the capital asset pricing model, the CAPM. And Modigliani and Miller assumption. We will get there. That one is theory. We'll get there, right? A little calculation. Excuse me. Now, just know that cost of equity is divided into 2. Method of calculating cost of equity is divided into 2. The dividend valuation and the capital asset pricing model method of calculating what? The cost of equity. Now, let's start from the dividend valuation method. Can you see my screen? Under the dividend valuation method, there are 2 methods. Class, under the dividend valuation method, there are 2 methods. The dividend valuation with growth and the dividend valuation without growth. What does that mean? You can use, in calculating the cost of equity, in calculating the cost of equity, there are 2 methods to calculate the cost. Dividend valuation method and the capital asset pricing model. For those who are coming from skills level, don't worry. I use the CAPM method. Don't worry, you see the full meaning. C means CAPM. C means capital. A means asset. P means pricing. M means model. Don't worry, you will see the full. What is it called? You will see it in full, right? Now, the dividend valuation method. Under the dividend valuation method, there are 2 methods. Can you see it? The dividend valuation model without growth. What does that mean? Dividend. It means that you, as an investor, you invested in one of the bank shares or one of the consumable goods or one of the communication or anything or technology or tech. 2024, you receive dividend of 20 or of 3 naira per share. 2025, you receive the same dividend of 2 naira per share. What does that mean? It means that your dividend is constant. There is no growth. The question is, what is the cost to the firm? What is the cost? We know it is a return to you. We are not calculating the return to you. We want to know the costs without growth. Which means that, do we have, I think there was a time I made a post on dividend paying stocks and non-dividend paying stocks. I think sometimes last month or 2 months ago, right? You can check. There are some companies that they don't pay dividend. Their dividend, do we have such company in Nigeria? That the dividend will be constant. You pay 2 naira. At least there, even if there should be a slight growth, even if it is just a kobo, right? When an investors receive a constant dividend, maybe to perpetuity, and that is why it is called the dividend valuation model without growth. The question is, how do we calculate the cost of the dividend valuation method without goods? Class, you see all this information about cost of equity is divided into two. Please, the dividend valuation method and the capital asset pricing model. Now we are in dividend valuation method. And under the dividend valuation method, there are two methods of calculating the cost of equity. Namely, dividend without goods, which means that an investor will receive a constant dividend perpetuity, right? We'll get to without with what? We'll get to with what? With goods. The question is, how do we calculate the cost? It is calculated as KE equals to D1 divided by market value. Class, let me quickly say something here. Fatai. Okay. Now, in a scenario question, at the end of this explanation, in scenario question, the question will be like, they will give you maybe dividend. You see the dividend, you see whether there is a growth. It is the question that will determine which of these two methods you will use to calculate the cost of equity. Either dividend valuation method or the capital asset pricing model. Even if it is dividend valuation method, which of these two are you using? It is the question. The question. When you read the question, it will show that, oh, there's no growth. So these people are receiving constant dividend. You will see it. We will get there. Right? Now, it is calculated as the KE equals to D1 divided by MV, where the cost of equity, KE, is equals to the cost of equity, D1 is equals to the current dividend, right? It will be stated in the question that the company pay dividend or declare dividend. We will get there. There are two things there. If it is stated that the company declared dividend, they declared, did they pay the dividend? The question will state that the company pays this dividend this so date. The dividend is this, right? So you should know that, okay, this is the current dividend. Now, MV, if you declare dividend, does not mean that you've already paid it, right? You just declare that, oh, we'll pay our investors tonight. That is why you see what happened in the market. When you see a company declare dividend, you see the market will scatter. People will be rushing to maybe to buy more shares, right? So the market value, MV, is market value, right? Market value Ex-div. Market value Ex-div or market price Ex-div. The question is, what is market value Ex-div? All this thing is per share. Maybe the market value maybe 2 naira per shares, 2 naira per share or 5 naira per share. That's why I say market price Ex-div. The question is, what is market value Ex-div or market price Ex-div? Ex-div means that dividend has been paid. Market value cum div means that dividend is yet to be paid. Market value Ex-div. It will be stated in the question that the market value Ex-div is this. So you can use it as your market value Ex-div. Fine. But if in the question, and the question states that the company declared dividend, have they paid? And the market value is this. Class, if a company declared dividend, that market value you see when a company declared dividend, it is called market value cum div, because the dividend is yet to be paid. The company just declared. That is why we have the market value Ex-div and market value cum div. When a company paid dividend, company will surely pay the dividend from their price, right? And if they pay this dividend, it is called market value Ex-div. The NV will become Ex-div. But if the company just declare, they are here to pay, that price that you see in NGS, it is called market value cum. It is called market price or market value cum div, because you are yet to pay your dividend. However, I may decide to bring a question that the information given to you is market value, is just market value cum div. Why? Because the dividend is yet to be paid. So if you are given an information that the current dividend is this, they declare dividend of this, and the market price is this, they do not tell you that it has been paid. They just say they declare, and the market price is this. That means that market price is cum div, because it is yet to be paid. Now, because we need market price Ex-div in our formula, and you are given that the dividend, they just declare dividend, or the market price is this. So, and what we need is market value. What we need to do is that the nominal price minus the outstanding dividend that are yet to be paid. If you minus it, you will have the market, or you use, let's say, not nominal price, use market price. Thank you. Let me change this. Yeah. So let me create a scenario. A company in a question. I'm just, all this scenario I'm creating is what you may see. That is why I take you to NGS, so that you will have an understanding of why is it Ex-div and why is it cum div. Now, a company declared dividend of 2 naira. Has it been paid? No. Then the market price is 1 naira, or the market price is 5 naira. And from our formula, we need market price Ex-div. For you to get Ex-div, it has to be the market price minus the outstanding dividend that is yet to be paid. You have the market value or the market price Ex-div, so that you will not use it in your formula here. Class, the market value cum div means that we never pay dividend. The Ex-div means that the dividend has been paid. So you will see a case scenario in question whereby the company will, it will be stated that, okay, the market value or the market price is yet to be paid, or you have the market value. So once the question give you market value Ex-div or market price Ex-div, just use it direct. It means that it has been paid. It is only when they tell you that, oh, they declare this dividend though, and the market price is this, That market price is cum div because it is yet to be paid. For you to get market value as div, you need to do what? The market price minus the what? Minus the outstanding dividend. Class, am I communicating?
Yes.
All right.
Yes, sir. You're communicating, sir.
That's fine. That's fine. All right. So this is the formula for calculating dividend. Using the cost of calculating the cost of equity without goods. Without goods. This is the formula. And these are the ingredients you will use to, you know, when you want to cook soup, right? You need some ingredients. Is that not so? So these are the ingredients you need to make it what? Look nice. To make it make sense, right? These are the ingredients. So make sure you know it as we move. Now, if in the question, and don't forget that there are two methods of calculating cost of equity: the dividend valuation method and the capital asset pricing model. Under the dividend valuation method, there are two methods: the dividend with goods, without goods, and with goods. Now we are in dividend with goods. So it is in the question that you will see that, oh, JITCO or one of the banks or any shares in 2023, their dividend was 3 naira, 2024, 6 naira, 2025, 15 naira. That is growth. There is a growth in dividend. You just need to get the percentage, but you don't need that here, right? You don't need, but we need to calculate. In theory, you need to calculate the growth rate actually, right? You need to do what? Calculate the growth rate. Now, you can see that there is a growth in that dividend when there is a growth in dividend. So in a case where you see a series of dividend in a question, you see a series of dividend like this, you see them. You will get, I'll show you a sample of how you will see the series of dividend in the question. Then you should know that, oh, and the question says calculate the cost of equity. Sure, you cannot use dividend with without goods. And you see that there is a dividend with goods. Oh, the first thing, okay, calculate the cost of equity using the dividend with what? With goods. Now, what is the formula? The formula is equals to KE equals to D1. The D1 is the current dividend, 1 plus growth rate divided by market value S-div. Don't forget, S-div means dividend has been paid, or market price S-div means that dividend has been paid. When the dividend is yet to be paid, you have to calculate the market value S-div, which I gave you the formula here, right? The market price minus the outstanding dividend, right? Then plus, can you see? Plus what? Plus growth rate, plus growth, right? In practice, you can actually calculate the growth rate of dividend, right? But in this case, in theory, you can actually, there is a formula for calculating the growth, right? The growth rate. Now, where KE is the cost of equity, D1 is the current dividend, G is the expected annual growth rate, the growth. Then MV is market value S-div or market price S-div. For you to calculate, for you to get the market value S-div, if it is not stated in the question that the market value is S-div, if you see that, okay, the question says that the current dividend, they declare the dividend and the market price is this, you should know that, oh, dividend is yet to be paid. Oh. Therefore, for you to get your market value S-div or market price, you use the market price minus the outstanding dividend. That dividend that they declare, you have your market value what? S-div. Class, most times, this growth rate will not be given to you in the question, right? Most times, it will not be given to you in the question. The question is, how do we estimate the growth rate? Because we need to get this growth rate, this G. How do we estimate the growth rate? There's a formula, methods of calculating growth rates. There are two formulas, there are two methods of calculating growth rates: extrapolation and Gordon's. Class. Are we still together?
Yeah.
We are with you, sir.
Okay. Thank you. Don't forget how we start. We started from the cost of equity, cost of capital. There are two methods. Under the cost of capital, there are two methods: the cost of equity and cost of debt. Now we just want to face the equity first before debt. Then the cost of equity. Under the cost of equity, there are two methods of estimating the cost of equity. If you want to calculate the costs, actually, this thing is very simple. If you go back to it again, go back and watch the recording, watch it again, you understand. Now, under the cost of equity, there are two methods, right? Under the cost of equity, there are two methods: the dividend valuation method and the capital asset pricing model. We'll get there. Now we are in what? Dividend valuation method. Under the dividend valuation method, when you want to calculate the cost of equity, there are two methods. The dividend without growth and the dividend with growth. Right? The dividend without growth is calculated as KE equals to K1 divided by market value Sdiv. Sdiv means that dividend has been paid. Right? Now, under the dividend valuation with growth, which means that there will be a growth in dividend. Is that not so? And what is the formula for calculating the dividend with growth? D1, open bracket 1 plus G divided by market value Sdiv plus growth rate. Now, and I said that in every question, the growth rate may not be given to you. You have to estimate the G. This particular G, this G here, you have to estimate this G, which is what? The growth rate. It may not be given to you under cost of capital, right? You have to calculate what? The growth rate. But guess what? It is the question that will determine where which of the methods you want to use, right? In some questions, the question will not tell you to use the question will not tell you that use dividend valuation. No, you will be the one from the question. You will not see, is there growth in dividend? Oh, there's no growth in dividend. Is dividend given in the question? Okay, dividend is not given. Maybe you will now go and use the capital asset pricing model to calculate what? The cost of equity. So it's the question that will now tell you the direction of which of these methods you want to use. Now, for you to estimate the growth rate, there are two methods. That is why it is called dividend with growth, because you need to estimate the growth rate. That is, the company will pay you a constant dividend till what? Till perpetuity. We need to what? Estimate the growth rate. If you want to estimate the growth rate, there are two methods. One, extrapolation and Gordon's. What is extrapolation? That is the question. Extrapolation means we are given a series of dividend. 2023 dividend, 2 naira. 2024 dividend, 5 naira. 2020, we are given a series of dividend. You know that there's a growth in this dividend, though. Right? Now, can you see my screen, right? extrapolation, when you are given a series of dividend, you can see 20 kobo from 2021, 2 kobo, 2022, 5 kobo, 2023, 20 kobo. It means that there is a growth in that dividend. You need to calculate the cost of equity using dividend with growth. But you need to determine that growth rate using this formula, extrapolation, when you are given a series of dividend. And what is extrapolation? M represent the numbers of years. I will ask question here. I want to confirm if you are following, right? N represent the numbers of years. Why we have current dividend divided by earliest dividend minus 1. Now, from this dividend, excuse me, from this dividend here, which one of these dividend is current dividend? And which one is the earliest dividend? Class, you have 2023, 2022, 2021. What is the current dividend and what is the earliest dividend? Afọlọ́runṣọ́.
The current dividend is 20 kobo, that's in 2023, and the earliest dividend is 2 kobo in 2021.
Good. Good. Well done. Makes sense. Now, that is the earliest dividend. They can call it base. When you look at the checks on test, to tell you that it is base dividend. So don't be confused, right? They are together. So the current dividend is 2023, while the base or earliest dividend is 2021. N is the numbers of years, the growth rate. Go from year 1, year 2, year 3, year 4. Of course, when you're doing a financial, maybe from fundamental analysis, you want to buy a store, you want to buy shares, and you look at it that, okay, are they pay dividend in 5 years or in 10 years? What is the growth rate? You look at it. You calculate, okay, what is the numbers of years? Okay, maybe you want to estimate for 5 years or 10 years. That numbers is called 5 years. It's called N year in theory. Numbers of years, right? Numbers of years, right? Now, minus 1. Now, the question is, why do we have to minus 1? Why? Why do we have to minus 1 from this formula? Please, who can try? Why do we have to have N minus 1 if you are estimating for 3 years? And say, the growth rate I'm estimating for is 3 years. So why is the formula having what? Minus 1. Why? Anyone can? Why? Who can try? Can you use the chat button? That was fine. Okay, Elijah.
Maybe to remove the effects of the base year.
To remove what, sorry?
The effect of the base year.
Of the base year. Okay. That's fine. Okay, current year. Okay, because of the current. Okay, that's fine. Now, the reason why we subtract, the reason why the formula we have to subtract 1 is because there is no growth in 2023. Yet, there is no growth in 2023. You can see it moves from 2021, 2 kobo to 5 kobo. Is that not so? From 2 kobo to 5 kobo. Is that not so? Right? So, move from 5 kobo to 20 kobo. Now, 2023 to 2020, there's no 2024 that we will now say, oh, there's a growth in 2023 from 2023 to 2024. Right? So that is why the growth rate will be for just for 2 years minus the current what? Minus the current dividend. Class, am I communicating? Now,
Yes, sir.
you can see that we estimate extrapolation here. right? If you are not given the series of dividend, right, it may be Gordon's growth model. Don't forget there are two methods of estimating the growth rates. Either you use extrapolation or Gordon's. We will examine extrapolation, now Gordon's growth model. Now, what is Gordon's growth model? Gordon's growth model make use of accounting profit. It's from your earnings. Don't forget that dividend is paid from your earnings. Right? Dividend is paid from your earnings. When you have profit after tax, if you remove your dividend, we have your retained earning. Is that not so? In some companies that are not listed, your profit for the year will becomes your, what is it called, your retained earning. You know? Now, Gordon's growth model makes use of accounting profits. It makes use of what? Accounting profits. The question is, how do we determine the growth rate using the Gordon's growth model? The growth rate is calculated as G equals to R times B, where G is the growth rate. The R is the current accounting rate of return or return on investment. If you want to estimate the R is your return on investment. Class, we all do ratio. We did ratio, right? How do we calculate return on investment? Return on investment is calculated as the profit after tax divided by the capital employed. The question is, how do we determine the capital employed? Depends on what is given to you in the question. Capital employed could be net assets, could be total assets, could be total equity. Don't forget where we are coming from. The growth rate using the Gordon's growth model. G is equal to the growth rate. The R is a return on investment. Return on investment is calculated as the profit after tax divided by the capital employed. Capital employed could be defined as the net assets or the total assets or the total equity. Depends on what is given to you in the question. B is what we call retention ratio. Retention, retained earning, retention. Class. B is retention ratio. The question is, what is retention? Class, what is retention? Retention is profits minus your dividend. You have retained it, but we need the ratio. Retention means retained earning. Retention, retained. Right? Profit after tax minus dividend will give you retained earning, but we need a ratio. So therefore, you will now have profit after tax minus the dividend divided by dividend. You have what? Retention ratio. You don't need to, you can see retention, retained earning, profit after tax minus the dividend, retain, retention, retain ratio divided by the profit after tax. Right? So when you are done with that, you insert it in the formula to estimate the growth rate. There are two methods of estimating the growth rate: extrapolation or the Gordon's growth model. If you want to calculate this growth rate here, there are two methods under the dividend with growth: extrapolation or the Gordon's growth model. How do we determine the Gordon's growth model? R times B. R is your return on investment. B is your retention class. Don't forget that Gordon's growth model makes use of accounting profit. Even from the formula, you should know that it makes use of accounting profit. And accounting profit is actually subjective because of the method of what? The calculating depreciation. That is why, as an investor or as an investment analyst, most times you don't really you don't need to rely on the what on the profit. Rather, you have to focus on the cash flow, on the estimated future cash flow, right? Although in fundamental analysis, you will still use some accounting profit, right, to estimate for the future. We will get when we will meet in case studies class. We'll meet in case study class. Now, the major problem with this model, don't forget that it makes use of accounting profits, right? It believes that the only method to use is only focus on the equity part, and it is assumed that R and B is actually constant. Accounting profit is subjective. The model also assumes all new finance comes from equity, only from equity, no any other source. And it's also assumed that R and B will be what? Will be constant. So these are the major problem. But the assumption is the problem. You can say the problem of the model. Class, the question may tell you that, oh, what are the limitations of this model? Don't forget, all your formula that you use, even without looking at anything, the formula that you use is accounting profit. The formula relies heavily on accounting profit. It assumes that R and B is constant, and it believes that the finance will only come from equity. If that is established, the second method of estimating the cost of equity. Before I move on, don't forget at the beginning, there are two methods of estimating the cost of equity: the dividend valuation method and the capital asset pricing model. Thank you. Under the dividend valuation method, there are two methods: the dividend without goods and with goods, right? Under the dividend without goods, there is a formula to it: K high equals to D high, D1 divided by market value S-div. D1 represents the current dividend. MV represents the market value, right? If that is established, under the dividend valuation method, there is dividend with goods, which means that investor will receive a constant dividend till perpetuity, right? Now, it is actually an assumption though, because you can't see that if you receive constant dividend, I will not even invest in such company actually. So after that, there are formulas. There is formula for estimating to calculate the cost of equity with growth. In that formula, we have to estimate growth rate. Now, if you want to estimate which 100, like I can say it, maybe 90% in the question, that growth rate will not be given to you. So you'll be the one to use your own discretion, either to use extrapolation or the Gordons. Depends on what is given to you in the question. Now, I'm going to explain that part. The second method of estimating or calculating the cost of equity is what the capital asset pricing model. The capital asset pricing model. Don't forget that the cost of equity is a return, right? Don't forget that, who is this? Okay. Don't forget that the capital asset pricing model, don't forget that cost of equity is a return. It is a return to an investor as an individual investment. Fatai, let's say a following show invest in one of the bank shares. You are expecting something. You are expecting return, minimum return. You are just expecting it, right, from your investment. How do we determine the costs to the firm? Another method that we may use is the capital asset pricing model. Don't forget, It is part of financing function under the function of a financial manager. Okay, so under the function of a financial manager to make a financing decision, either you go by equity or you go by debt. Now, we are now in capital asset pricing model, the method of estimating the cost of equity. What is capital asset pricing model? Minimum return that investors are expecting, but we are interested in the costs to the firm, right? So how do we calculate the cost? Using the capital asset pricing model. Can you see? CAPM. It's calculated as KE equals to RF plus beta, RM market return, then risk-free. Or cost of equity equals to risk-free plus equity beta times risk premium. So it depends on what is given to you in the question. It may be this. The question may give you a risk-free, equity beta, and market and risk premium. The question is, what is risk premium? Because for everything you are doing, you need to understand why. When we get to a topic that I know that, oh, I'm not there, and based on research work, and I'll be able to say, okay, this is how it works, but I don't know if it is applicable in practice. Now, what is the risk premium? Risk premium is just like a compensation given to you as an investor for you to invest in what? In an equity shares. That is premium to you. That is additional. You know, you took a risk to invest in one of these tech companies. You took a risk. That risk, that is premium. That's additional return. That is what we call premium, risk premium for taking that risk. So the question may give you risk premium. So when you have risk premium, you will not have market return in the question. Class. So RE equals to our KE. Sorry. KE equals to the cost of equity for a company's shares. RF is the risk-free in question, either ACC or ICANN. The question may give you risk-free or treasury bill or government bond. So you should know that it is risk-free. It is RF. And what does that mean? Class, the question you may see maybe in the question risk-free. You may not see risk-free. But if you see maybe a treasury bill, government bond, that is your RF. Automatically it becomes your what? RF. It becomes your what? Risk-free assets. The question is, it is an assumption. That is one of the assumptions of capital asset pricing model. We will not treat portfolio actually. That is one of the assumptions of capital asset pricing model, because it is assumed that you are investing in a risk-free asset. Of course, in bond, if you buy a government bond, it is a risk-free. But in equity, it is not a risk-free, but it is just an assumption that risk-free will be treasury bill, there will be a risk-free in equity. Is that possible? You are investing in a share and you are telling me that, oh, it is risk-free. It is an assumption, but if it is in the case of bond, debt, you can say, okay, it is a risk-free because you will earn your return at the end of the period. Recently, FG bond, right? You will earn your return at the end of the period. So it is an assumption that there will be you are investing in a risk-free asset. Don't forget, from the calculation, from the formula, you see RF in calculating the cost of equity. And don't forget, you are expecting it. It is not that we must give you. Right? So when you are expecting something, and you are still putting in the formula, you are writing in the formula indicate risk-free. Why is it risk-free? When I'm expecting, why is it risk-free? That is an assumption, and one of the assumptions of capital asset pricing model. It assumes that you are investing in a risk-free asset, right? It is assumed that one of my best topic in SFM is portfolio theory because it is practicable, like you can relate it, and that is what we did last diet, right? No, now risk-free is Treasury B. Maybe if you see Treasury B, it means that it is risk-free. Government bond is risk-free. So RM means market return. Then B means the beta factor. Excuse me. Now, that is beta factor, which is systematic risk. Distinguished professional colleagues, this systematic risk, when we get to project-specific cost of capital, I will explain better, right? I will explain more about the systematic risk and all that, but let me quickly explain it here, right? Beta factor, that is systematic risk. What is systematic risk? This systematic risk is called market risk or unavoidable risk. Market risk, unavoidable what? Unavoidable risk. And what is unavoidable risk? Even the company they can't control it. What are the risks? The fluctuation or the foreign exchange. 1, 2, inflation. 3, GDP. 4, unemployment. These are systematic risks. It is unavoidable. Then the RP is equal to the risk premium. So we equally have the advantages of capital asset pricing model. So when you insert it here, you will have your cost of equity, which is this is the cost to the firm, and it will be a return, so equity holder. But we are interested in the cost because we are in cost of capital or cost of equity. So when you hear someone say cost of capital, you should know that our cost of capital, is it equity or debt? Because cost of capital is divided into equity and debt. Now, I'm going to explain this. We have the advantages. Oh, I didn't change this thing. Okay. Advantages of capital asset pricing model, right? Now, if you look at the formula, even without reading the advantages, that is why I usually prefer professional students to understand. You know, if you understand something, there's no how I can want to set the question, right? That is, I can tell you today that even out of the 68 newly qualified chartered accountants from next gen professional associates, you can ask 1 or 2 persons. The person will tell you that I can't forget this thing because I thought it was very simple in class, very, very simple, because we relate theory with practical, even if you forget. So please always try to understand something. So once you understand, there's no how I can want to twist the question. And you should be able to at least write something about that particular topic. Now, one of the advantages is that, don't forget, from the formula, it assumes it's consider only systematic risk. That is it's only consider what? Systematic risk. It's an assumption. Because in real life situation, in real life scenario, what affects business, all right? It is not only systematic risk that is unavoidable. Even unsystematic risk that are caused by the organization also affect the business, right? But it is one of the advantages, but it's still the assumption. You can't tell me that the only risk that affects business is just, what about unsystematic risk that is avoidable, right? High labor turnover, machine breakdown, a lot of things. Unsystematic risk. We'll get there. We'll get when we get to project specific cost of capital, right? Then, one of the advantages of capital asset pricing model is that it measures relationship between the return and the risk class. Don't forget that in this part, we mentioned risk, right? And the cost of equity, it is a return to an investor. So it's actually measure the relationship between, okay, the risk and the return. Don't forget, the cost of equity is a return. And in the calculation, from the formula, there is a risk. So definitely it measures the relationship between the risk and return. So you can read up. So I want to explain all this. You have to go and digest the equity. So when you digest the equity, when we come back, we will now do what? Well, I will explain debt, because you need to, for those who are just coming from skills level, you need to digest this, right? You need to. It's very important. Distinguished professional colleagues, can we continue the lecture, or you go and digest the equity part and we'll come back? So I think you should go and digest the equity part, right? Just go and digest it. Make sure you understand the formula. Put it down, right? You see, all of you, I think at the beginning we have about 60 participants, right? Now we have, you must pass. You see, that pass, you will not only pass, you will also use it. For those who are in finance line, you also use it. At the end of the SFM, you will also still use it in your places of work if you are in finance line, right? And use it for so many things, right? So please go and digest this particular the cost of equity. So we are together in this, right? And you must pass, right? We must work together. Another thing is, please don't send me DM if I don't instruct you to do that, please, because currently now I have about more than let me say more than 500 messages. Please, Christy, she's among the partners. So whatever thing you want to discuss that has to do with maybe payment for material or lecture, she will explain. Please. My own is to come to class, to make sure that I come to this class, I deliver my lecture, update my lecture material, then we move from there. So please, just send message to the platform. Just if you want me to attend to you, right? If you want me to attend to, just tag me on the platform. Tag me. I will respond to your message. But don't send me DM, please. I beg you, please. Imagine you send me DM. FM students send DM. PM students send DM. Case study send DM. I beg. Now one kill me. so I beg. Imagine. I'll read messages. They are here. Where will I even start from? So please, just send it to the platform. Tag, even if it is Christy, tag her. She will respond to the word message, please. Thank you so much. So if you have question, you can quickly unmute your mic. And if you are here to subscribe, to our YouTube, please remember that this class is free class. So please go and subscribe. Thank you. So if you have question, quickly unmute your mic. So let's rub minds together. I'll start from Afolorunso.
All right, sir. Thank you for the class. Yes, please. Thank you for the class. Yes, I still want to talk about the last part on the government bond treasury bill. On assumption that the government bond and treasury bill is secured. But suppose, I'm just thinking anyway, I may be wrong, but suppose there is maybe natural disaster or there is war, can we still guarantee that the T-bills and the government bond is secured?
Well, that's a very good question. Based on indicators, they said it is risk-free. But in this equity, it is not actually free. In this equity part, it is an assumption that it will be free. The asset will be free under the capital asset pricing model, because you want to determine the cost of equity, something that you are expecting, and you now say, it is a risk-free asset from the formula. Oh no, it means that there is an assumption that say, the risk-free asset under the cost of equity, there is the asset is risk-free. But back to your question, I don't know, but it is risk-free. Let's just take it as risk-free, because there is an assurance that they will pay you back.
All right.
Do you get? You get. Thank you.
Yes, thank you.
Yeah, you're welcome. Usman Aziz.
Good afternoon, sir.
Good afternoon.
Really appreciate your effort concerning this SFM thing. If I'm just saying, I'm saying my own mind though. If I can even help us, just delete this SFM thing, but there's nothing we can do about it. We just have to write it, because last night I ran away from it. If you can remember my name, Usman Aziz. I ran away from SFM last night, but I don't have option now than to write the last paper and pass. So today's class, I think it was okay. As you said, we are going to read on the part that you took us this afternoon. I'm just trying to introduce myself again to the platform. Thank you, sir.
Thank you, Usman. Thank you. That's fine, but you can't do without it. SFM. It's actually very simple. It's just your understanding. That is it. It is not to come and tell you this is what textbook. No, we are not talking about textbook. We are talking. ICANN exam has gone beyond that. Like, you should just go and cram one thing and come to the class and tell students that, just take it like this. When we get to a topic that I know that this thing, let's just move on. Let's take it like that and move on. I will let you guys know. Like, I will let you all know, right? We are both professional colleagues. Yeah, so thank you so much, Usman. So I believe you can do it, okay? So just follow up with the lecture. Make sure you go back to the YouTube. Make sure that is why I don't send from the material. I will not send solution. I have questions. I will not send the solution of the question to you, because experience has shows that over the diet, you will see professional student will see suggested solution there. Instead of them to go that same question, they will come to your DM and ask that same question. That when you go to the YouTube, you can get it. But because you already have the solution, scanning, okay, it's like this, okay. Oh, this is cost of equity, okay, it's 5%. That's not the process. It won't help at all. That is why, please, the material will be my own material, like the one I will update on I will send, right? It will not be. I will not add suggested solution to it, right? So that you know if you are to pay for it or you will not pay for it, that's fine. But I will not include suggested solution to it. Please, you must write. You must go back and listen. You must write. You must come back to when we come back under the cost of debt, you must have question. It is not possible that you tell me that you will no, you must ask question. Right? So SFM is, please just be rest assured that you will pass it and believe in yourself. Right? I will be consistent with my lecture. Go and check. Right? With my record, go and check. You will know that I am consistent. If you talk about consistency, I will be in class even before the time. But you also need to do your own part. You also need to, because if you are not consistent, maybe due to one or unavoidable reasons, right? I'm sure I will solve the questions. Sure, I will solve the questions. I will solve. I under the cost of capital. I think I have like 3 questions to 4 questions. I will solve 2 or 3. Then you do 1. That's fine. I will solve 3. I can solve 2 or you solve 2, right? So, and what else? So you have to do your part. You have to. If you're not consistent with lecture, go back and check. Okay, this is what they did today. Just go back so that, because once you miss cost of capital, once you miss this cost of capital, it will be very difficult for the professional student to understand SFM. That's it. It will be very difficult. But once you understand cost of capital, you can do anything in SFM. As we move now, project specific, as we move now to investment appraiser, as we move now to valuation, one of my best topic in SFM, valuation of a business, you know, the merger and acquisition, all those things, right? We'll get there. So please, just follow as we move. Thank you. So if you have any other question before we go.
Hello, IB.
Sir?
Well, good afternoon. Good afternoon,
Good
sir.
afternoon.
Thank you for the lecture. I really appreciate your efforts, sir. May God Almighty bless you.
I mean,
So my name is Abbas. So I wrote last diet, but as fate have it, I failed. But I know this diet will be my last diet of writing SFM, and I'm going to qualify this diet by God's grace.
Yes, I
So,
like that.
I want to ask, your material for last diet, can we still use it, or you are going to update it so that we're going to get another one?
I'm not the kind of, what I want to say, I don't want you to look at it as if if it is money part, that is the least thing I can ever think of, right? Because if it is money, let me start from there. If it is money, we will not establish next gen. We will not be where we are today. Now, back to your question. You see, my question of last diet will be different from this diet. Just get that. I may pick like 2, then add to it, because time to time, as a tutor, you need to update yourself. I've updated myself within that 1 month. That is why the concepts of the material might not be the same. So you have the option to stick to that, or you get, so you have the decision. You get, so that's it. Thank you.
All right, thank you.
Yeah, you're welcome. So any other question? Are we good? Let me check if my other. Okay. My other is not here. Okay.
Hello, sir. Please, can I just make a request?
Go ahead, please.
Yes, I understand the part that you really want us to actually practice whatever we do in the class. But for Riaza, or let me not say Riaza, while doing a kind of final reading, I came across a challenge. I actually printed those materials. So, and there was a kind of challenge of retrieving my note and all the rest, but the printed material was what I took along. And unfortunately for me, there was no solution. So I want to beg, even if it is one or two of the solution, please, you may have to leave it on the material while other questions remain unsolved, which is going to be an assignment or take home an assignment or project for us, please, sir.
Okay, that's fine. That's fine. That's fine. So as you mentioned, right, I will think about it, right? I have to go back with my team, with our team, and see what we can do, because I can tell you, why I make that decision, I know what I'm actually saying, and I've seen it, right? It has happened over the diet, right? Even before I come online to take SFM, I've been taking it, and I know the implication of that, but no problem about it, right? Just be rest assured that I will do something about it. Do you get? Thank you.
Thank you, sir. Yes, sir.
Yeah. Any other question before we go? Any other question?
No.
Yes,
No, sir.
please. I have a question. Sorry.
Please go ahead.
Yeah, please. Will this, I don't know, I saw something online. I don't know if it's true, if this November diet would be CBT based or something like that. I saw something like that. I don't know how true that is, please. Help me clarify. Thank you.
You're welcome. For now, we'll not really get information about the online, right? So I think what actually happened was that I think the new ICANN president, right, he mentioned during his inauguration, I think during the investiture, that he will bring what is it called? CBT, right? So that you use computer to write exam. But then we are still looking at, because ICANN cannot change syllabus, that same diet still introduce CBT. So they have to settle for one, even technically. Do you get? So they've not talked much about the the CBT stuff. So just for now, just you can just ignore that for now until we all get valid information from ICANN. Thank you.
Okay, thank you.
Any other question? Okay. Clementina, please. We need to go, please. I think I need to go. Please, Clementina, if you have a question, quickly, please.
Good afternoon, sir.
Good afternoon.
Good day, sir.
Yeah, I'm with you.
I
Go
just
ahead,
came
please.
in. Can you hear me, sir?
I'm with you. I'm with you.
I
Go
just
ahead.
came in. I just came in and I've missed the lecture, so I don't know when this lecture will be posted again for me to go back to.
I check the YouTube now. You will see it there live. Go and check. I'll put it on the playlist. Please check anything about anything SFM, SBR, all the courses we offer. Go and check playlist. You check playlist, you see it. You see the recording and everything. You see it there. Just check the playlist.
Okay, thank you, sir.
And please, if you are here to subscribe, please go and subscribe. So on this note, I think there's no other question. I think, and we have to go. Don't forget, we just started like this. So sometimes my class will be maybe 3 hours class. Just prepared, right? 3 hours class, 3 hours, 4 hours class, right? So because of introduction, you need to go and digest this part of cost of equity. So when we come back, we'll talk more on that before we move to a question. So thank you so much, everyone, for joining. And should I say have a wonderful weekend? Okay, have a wonderful weekend. Because I can. So thank you so much. Thank you. And don't forget to join your lecture. I think
Thank
you
you
have
very
lecture.
much, sir.
Yeah, you're welcome. Mr. Maruf will come on Tuesday. Yeah, hopefully Tuesday. We take your SFM on Tuesday. All right. Thank you so much. Thank you, everyone. Thank you.
Hello, sir. Hello.
Yeah.
Please, the timetable on Tuesday, 6 to 8.
Yes, sir.
For those
Yes,
for
sir.
those that are going to work, I think that 6 is too early.
Ha, ha.
If anything you
Okay,
can do for us,
okay, sir.
but
Okay,
by
sir.
then you are still at work.
Thank you so much, sir. That is noted. Noted. Thank you. Thank you. Yeah.
I greet you especially, Mr. Ivy.
Hey, Eda. Eda.
My,
You're supposed to
my,
introduce
my managed man.
Eda.
I greet you, sir. Thank you very much. I
Eda.
appreciate it.
Oh, I forgot to introduce you. Okay, don't worry. Now, next class.
Good afternoon, sir.
Thank
Uh-uh.
you.
Comfort. Don't worry. Don't worry. We'll see
Yes,
in camera.
sir.
We'll see in camera. We'll see in camera. All right.
Why wouldn't you? Leave that one.